Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. Today, I'm talking about banking seems like pretty much like everybody else this past weekend. We had some bank issues in the last couple of days before the weekend. Now we are on Monday. I'm recording Sunday night, so I don't know how Monday's going to play out yet. It's going to get really interesting because the Federal Reserve is already meeting on Sunday. I think they're meeting right now. I might have to make another video before the morning. We'll have to see. But today's video, this video right here, is going to be talking about Silvergate and talking about Silicon Valley Bank. Why did they go under, and what is the implications, in particular with Silvergate, back to crypto, and how it comes to probably another video I need to make about USDC losing its peg, and we'll get to that too. But there's so much going on, and it's so dynamic. It's changing so rapidly. I needed to get videos out as quickly as I could. So here I am making a bunch of videos Sunday night, and we'll see how long they last. But we'll see. Here we go. Silvergate. Okay. Silvergate was a bank started in California. They went up, long story short, they went up holding a lot of assets for cryptocurrency companies, a lot of blockchain companies, a lot of developing companies. And what they did is they found a niche that they could serve a community that was underserved, which is the cryptocurrency companies, because a lot of banks didn't want to touch them. I harken back to the cannabis business to like 10 years ago, where I don't even know if it was 10 years ago, but it was legalized in Colorado and Oregon and other states, but on a state level, but not on a federal level, which means that the Federal Reserve banks, the FDIC insured banks, you couldn't have an account there and be dealing in the cannabis business. It was illegal. So banking and there was a lot of risk reward type scenarios going on if you were a bank that wanted to serve that community versus you want to adhere to the federal standards. It got tricky. So fast forward to today, or last few years, crypto companies in the last 5 years or so they were getting funded to start their projects, right? Especially in the United States. Okay. And then with the ICO, the ICO boom in 2017, where everything was building on top of Ethereum, everybody was going public, everybody's launching coins. These projects had a bunch of capital, but they didn't know where to put it. And they had obligations. Every week they have to do payroll. They have to pay for certain developers and assets and so on, office space, whatever. So they needed bank accounts. So they turned to companies like Silvergate and said, hey, can you hook us up with a bank account and work with us? And we realized that, our assets can't be insured because they're going to be over 250,000, but we have nowhere else to put them. So this is how a bank like Silvergate wound up with so many accounts that were over that $250,000 insurance line that was a concern for many people. It used to be only 100,000, by the way. Then they moved it to 250. So your minimum, if you have an account up to 250, you should be good in theory. But unfortunately, that's not the case. And that's probably another video I need to make about FDIC insurance. But FDIC insurance is underfunded by a good 97, 98% or more. And now that we have a second bank failure, the Silicon Valley Bank that has stepped in, or they were having issues, and they're part of the reason that a lot of cryptos are also having issues, because other projects were exposed to that. So you have two banks that were going under or being taken over that had a large exposure to the cryptocurrency world, either from we're dealing directly with the project or dealing with venture capital companies that dealt with cryptocurrency banks or stored assets that worked with, say, Coinbase and their USDC token. So now you have a banking system. You have a bank that's highly exposed to cryptocurrency projects. So you're very segmented in your sectors. And then you have an issue where cryptocurrencies are going down in price, along with a lot of other assets. Banks have issues, and you have banks that received a lot of assets in the last couple of years. So in 2020, in 2021, there was a lot of stimulus that was currency printed out of thin air, and the banks had this, but they didn't want to be overexposed. So they had all these deposits, which is a liability to a bank. They have to return that money to people on demand. If you want your money out of your bank account, you're supposed to be able to provide it on demand. But what banks also have to do is they have to take the the deposits and use that money, make it work for them so that they pay all their clients their money plus interest, plus make money for their shareholders. They're running a business. The bank is running a business. To operate that business, they're doing one of a few things. They're either writing new loans or they're taking the assets under management and try to create more assets. So rewind a couple of years ago, we have all these assets that are being created. We have all this currency being created out of thin air. Okay, the stimulus money. Banks are receiving the stimulus money. In addition, we have cryptocurrency projects that have all these funds in a declining market for cryptocurrency. So they're trying to diversify, put their assets somewhere that they'll last a little bit longer, and also be able to meet their weekly, monthly payrolls. So what banks were forced to do a couple of years ago, if they had too much deposits, they had to buy whatever was available. Now, in 2020, a lot of businesses weren't taking out loans, right? They were not even open. So what's left? Treasury bills. The currency that just got printed by the Federal Reserve was sold for Treasury bills. So now there's Treasury bills that are out there, which are supposed to be the most stable thing out there, but they were only offering, say, 1%. So it's not the most attractive thing for a bank to buy, especially for a longer term holding. They would much rather buy it for a shorter term. But if there's not much in the market and you want to take that cash and move it into something that's earning something, they were buying these 1%, 2%, 3% bonds, these treasury notes, because there was nothing else for them to put them in. They were paying 0% back to their holders for interest rates for deposits, but they're only making 1 or 2% on these bonds. So now we move forward a couple of years. We have the Federal Reserve, which is raising interest rates, which is making present bonds worth more than older bonds, because the present bonds pay 4 or 5%. The older ones paid only 1%. Well, guess what? The banks are now like they're overexposed now to these treasury bills, and they have starting to have pressure from both ends. They have depositors coming and saying, "Hey, we need to draw these down. We need to draw down on our accounts." Is what, like, it could be a company that has to make payroll, which is probably what happened with Silvergate, and they had to get all the currency out of there and pay their people, but they were underfunded. They were not as liquid as they needed to be for all these companies to come to them and say, "Hey, we need to pay payroll and get money out." So they have an issue. So now what Silvergate needed to do was to put more assets on their books so that they can counteract their deposits, which is the liability. So in other words, they had to take all their assets, all their bonds that they're holding and waiting, hoping that they get to maturity and they can put them into something better. Right now, they couldn't, so that they needed to make them available for sale. So when you make a bond available for sale, you have to revalue it to the current present value versus what you bought it for. So if you bought $1 million bond at 1%, and now you have to revalue it, you might lose 4 or 5. You might only be worth like $950,000 instead of $1 million, because the current rates are 5%. So when you take that haircut, those haircuts add up. And now even though you've got all these assets on your paper, on your books that say, "Hey, we have treasury, but they're going to just take a while to pay." But guess what? It's going to take a long while to pay, and they're not worth that much. So if you have to sell them or mark them ready for sale early, now you have less assets on your books, and now you look even more over leveraged with your loans and your liabilities. So it's kind of a vicious circle that kind of happens when you have all these. You have too many deposits that are now tied to longer term investments, which are not giving you very much yield at all. And that's what's happening with these banks. Wrapping this up before I start talking into crypto, and I'll do that in another video on USDC, and it's losing its depeg or depegging to the dollar. You get these issues where you have runs on banks, and banks, like, when you lose faith or trust in these banks, what happens is someone learns about it, they get wind of it, and they go and say, "Hey, it's probably a good idea or quiet, get your assets out of this bank." Well, if they do that, they tell their friends, and it's kind of the telephone game, right? A couple people do it, they tell a couple people, and all of a sudden it's like dozens, it's now hundreds. Now everybody's trying to get their money out of this bank, their currency out of this bank, because on whoever's last is not going to get anything. So couple that with FDIC insurance, and you've got all these different issues that are happening with banking right now. It all ties back to crypto. It wouldn't surprise me at all if this is a gateway for them to say, hey, here's another crisis. Time for us to not only allow regulations, but also how about let's launch some CBDCs too. So all this could be coming together. Stay tuned for that and for more. I'm going to keep this video short because I got to go on to more conversations, but there's going to be plenty of videos Monday and Tuesday coming out. So with all that said, I'm going to close the drawer on this one. Say follow leader, and I will talk to you soon. Take care.